Do you know the difference between a tax deduction and a tax credit? It is okay if you do not know, but in this video, I am going to explain the difference between a tax deduction and a tax credit. Why? Because we need to fill up your bank account this year. And by you knowing the difference can definitely increase your tax refund and reduce your tax liability. But before we jump in, I'm gonna need you to like, comment, and subscribe so you don't miss out on any wealth building information. Now stick with me to the end so you can understand how to increase your bank account. What is a tax deduction? A tax deduction is where you go out and you incur an expense that is tax deductible according to the tax code. Allow me to give you an example. I am running a business and I go pay $2,500 as an advertising expense. That expense paid out of my pocket, whether I pay it by cash or check, or whether I put it on a credit card, is going to be a deduction against my income. Therefore, if I've made $10,000 for the year and I have that $2,500 deduction, I am going to be able to deduct that $2,500 from the $10,000 and come down to net profit of $7,500. That is a tax deduction, and we want to try to get as many tax deductions as we can to lower our profit for our business, which is ultimately going to lower our taxes. However, a tax credit works completely different. A tax credit does not reduce the income from your business. A tax credit is not going to be a deduction. A tax credit is actually going to be like dollars paid in tax. It's almost like having money already set aside for your taxes. Allow me to give you an example of how a tax credit works. Let's say that I am finished preparing my taxes and my taxable liability is going to be $10,000. That's how much I owe IRS. Or you can also have state tax credits. If I get a credit, and say I get a credit of $3,000, the $10,000 that I owe is now reduced by the $3,000 credit, meaning I only owe now $7,000. $10,000 was my original balance due. I got a credit of $3,000 and now I only owe $7,000. So tax credits are like gold to you. And I want to make sure that you understand some of the tax credits that you can take advantage of. There is the child tax credit. That's the credit that you get to take when you have children on your tax return that are below 17 years of age. And if your child is below 1, that credit could be even higher. So that's what we call a child tax credit. We also have the child care credit. When you have to put your kids in child care to watch them while you're working, or even being self-employed as an individual business owner, you can get the child care credit. That means that you paid somebody to care for your child and you can get a credit for that. So you want to look into that. They also have the health care credit for individuals that pay for health care. They also have the earned income credit for individuals that only make a certain amount and have children on their tax return. They have the educational credits for individuals that are trying to further their education. And with some of the credits, like the educational credit, they have various credits within that category. of credits. So like the educational credit, they have the American Opportunity Credit, the Hope Credit. They also have energy credits for people that are putting energy efficient appliances in their home. They have like the solar credit. They have the vehicle credit. These are the reasons why you want to take on credits and become aware of credits, because credits are like money in your pocket. When you are taking tax deductions, you have to keep the receipts for various deductions that you take, and you got to make sure you have proof of payment. How did you pay for that deduction? Remember, was it by debit card, credit card? Did you write a check for it? Did you pay cash for it? Cash can be tricky because you got to be able to prove where you got that cash from. Don't try to come up with a bunch of cash receipts and you end up adding to your income, because IRS is very aware of that. Now, when you take a tax credit, you are typically attesting to the fact that you qualify for the credit. That means that you and or your tax professional is going to check off a checklist that goes into IRS that says, yes, I verified that Mr. Jones has a kid. I verified that he paid child care credit and that he's eligible for that because I looked at the child care receipt. It had an EIN number on it from the provider. Or I verified that he had these minor children and I am aware of them. I looked at Social Security cards. We have to verify things differently when you take a credit. But do not be afraid of verification. I will verify what's necessary so that I can get my tax credits. The key is we're always going to be honest. You're going to take the credits that you honestly qualify for, and there are a lot of them, and be okay certifying and signing off on the necessary forms, because we are all about following the law. And when you follow the law, you can reduce your tax bill substantially, because there's so many areas of the law that you're probably not even aware of that can really help you reduce your tax bill above and beyond what you are accustomed to. When we are minding our business, not only do we have to make sure that we are making income, we have to make sure that we are making net profit, we have to also make sure that that money is not going away to the government because we're not paying attention to other things that we need to be paying attention to. A $5,000 credit is better than a $5,000 tax deduction or $5,000 of business profit. So make certain that you are paying attention. So now that you know the difference between a tax deduction, which is a deduction against your income, and a tax credit, which is money in your pocket, now that you know better, you gotta absolutely do better. So what does that mean? That means you gotta like this video, you gotta subscribe, you gotta share this video with a friend, and you gotta make an appointment with a tax professional to be a good steward of your money and make sure you have a tax strategy moving forward.